textile, construction, and agriculture sectors. And I'd also like to appreciate and acknowledge the presence of the Trademark East Africa team members and the broader FSD network members. Thank you. So we'll just we'll wait for a couple of minutes, 2 more minutes, then we can start this. Okay, we now have about 60 participants, so I think we can get into the agenda of the day. Again, I'd like to welcome everyone for joining us for this webinar, where we launched the Trade Finance Landscape Reports that we did in partnership with East Africa, so FSD African Trademark East Africa. So we'll go through a bit of housekeeping, then we can get into the agenda of the day. Angela? So the webinar is scheduled to last for 1.5 hours. We have disabled all participant audio and video functions, and please use the Q&A box for questions. We have not enabled the chat box, and we are recording the webinar for data privacy issues, and we will send all materials via email to all attendees within the next 48 hours. Okay, so we will start with introductory remarks by the Trademark East Africa CEO, Frank Matsat, and then we will have brief remarks by Getachew, who is an FCDO private sector advisor in Ethiopia. Then we will go to a brief presentation on the reports by Open Capital Advisors. Then we'll get to the panel discussion, which will be moderated by Jared Osoro, and then we'll have closing remarks. So now, without much ado, I'd like to welcome the Trademark East Africa CEO, Frank Matsat, to make his introductory remarks. Frank, over to you.
Thanks, Shakila, and good morning, everyone. Really great to join this webinar today, and I think it's going to be really quite an interesting one going forward. Just to say a little bit about the roots of this study, and I think it's important to say that both Trademark and FSD Africa were basically responded to with this study to a need out there, and this was a need that was born out of the challenges faced by a textile and garments investor in Kenya, Hela Garments, that reported quite a lot of difficulty in raising trade finance to keep its operations going in Kenya, particularly for the import and export aspects of raw materials. And in fact, I think Hela had to resort to finance from Sri Lanka to keep the operations going. So it was felt actually that a study like this was needed. And the scope of it was really to look at both the supply side and also the demand side for trade finance, and particularly focusing on textiles, the agribusiness sector, and construction. And the study covered both the East African community countries and partner states, as well as the Horn of Africa, particularly Ethiopia. So, as I said, welcome to this webinar. I'm really feel great that this has been co-sponsored by FSD Africa and Trademark East Africa. And I think we've got a great lineup of panelists from the finance community that will talk to a lot of the issues raised. I think just to say, first of all, thanks a lot to FCDO, the UK government, for financing the study. We really appreciate that. And, I just want to stress how important unlocking trade finance is for trade. Obviously, to unlock trade and investment, companies need access to trade finance in a way that's low transaction costs and meets their needs. So this is particularly important, I think, at this time when we're talking about the Africa Continental Free Trade Area, the agreement, the AFCFTA, because the continent wants to trade much more with itself. So the study, I think, will be useful in thinking about the hurdles and challenges that need to be addressed. I'm looking forward to the debate later on in this session. And I think, although we at Trademark East Africa are not directly involved in trade finance, we recognize that it is a binding constraint for the trade sector. So hence the importance again of the study. Just to say a little in terms of what we as Trademark East Africa are trying to do to help traders and the export sector, we're doing some work at the moment to look at the horticultural exporters and think about how they can operate with good levels of finance to reduce their working capital needs and also some of the air freight costs. So we're looking at a guarantee mechanism, I think, with open capital. Secondly, we've been doing work on digital trade and digitization that could take up a lot more functions of trade finance. And you know, a lot of the work we do is around trying to make sure that trade is seamless and operates on a blockchain and basically allows people to view documents in a way that reduces time and cost. We also look at standards, and standards are critical for trade and obviously for the affiliated finance. And here we've been doing a lot of work on making sure that particularly grains are produced to the right standard, making sure that they meet aflatoxin levels, and also we've been looking at structured trade for food commodities. And finally, we've also been working hard with informal cross-border traders that gradually want to formalize their work. Particularly, we've been working with women trader associations, and with that comes the need to look at finance. So really delighted to be here today. And I think the study does help to identify the key constraints and challenges, but also the opportunities. And I think, you know, to me, it's what comes out of this seminar and the reports that matters. And I'll be looking forward very much to taking this forward into action with FSD Africa. And I think, Shakila, we're planning to have a follow-up meeting with you on how, you know, the results of this study and the deliberations today will be taken forward into action. So with that, welcome everybody. And I really encourage everyone to really participate and to put your questions in. We've got a great panel. And with that, Shakila, I'll hand it over to you. Thanks very much.
Thank you, Mark. Thank you, Frank, for setting the stage for the discussions. And definitely, I think a critical output of this webinar is for us to have definite call to actions or way forward. So we hope to have further discussions, and that this is not the end of this report and the discussions on this report. And as Frank had mentioned, FCDO is a key donor for both Trademark and FSD Africa. And I will now invite Getachew from FCDO Ethiopia, who's a private sector advisor in charge of financial sector and deals also with trade finance, to just give brief remarks on the importance of trade finance to FCDO and what FCDO is planning to do in this space. Getachew?
Yeah, thank you, Shakila. Welcome everybody to this important event where we'll be discussing really a very important issue of trade finance. So as FCDO, we strongly believe that improving intra-regional trade is key for economic development and poverty reduction, as is rightly highlighted in the report. The intra-regional trade in Africa is very low, despite the fact that there is huge potential for the region to trade amongst itself, but things are not really happening in the way they should be. There are really underlying structural challenges, systemic challenges, and also some challenges related to policies. So it's with this strong belief that improving intra-regional trade by supporting efforts to facilitate trade, enhance trade in the region, that would help economic development and poverty reduction, that FCDO supports regional as well as national trade facilitation and enhancement efforts. Our support for trade development in the region ranges from continental efforts of supporting new trade development efforts like the African continental free trade area, its implementation in alignment with country level priorities, regional trade integration efforts, and also bilateral trade agreements between countries. And also we also support regional trade facilitation enhancement efforts, including efforts in terms of infrastructure development. For example, we support the logistics sector development in the Berbera corridor that we believe would be really very important to enhance trade in the Horn of Africa region. It's with the vision of support improving the overall trade development ecosystem that we also provide support for regional interventions like FSD Africa and Trademark East Africa. But also at national level, we also support policy reforms in trade areas. In Ethiopia, particularly, for example, we closely support the accession process for WTO. We also support trade enhancement efforts by the Ministry of Trade and Industry in Ethiopia. We also closely work with the Customs Commission to improve custom procedures. In our financial sector development portfolio in Ethiopia, also we closely support the government of Ethiopia in terms of improving the way traders access foreign currency, and also various trade financing products. So I mean, with the evidence generated through this new diagnostic study that provides really a comprehensive overview of the trade financing landscape in the region, we believe that we will be learning more about the challenges that traders and business people are really facing in terms of accessing trade finance, and with that evidence, we will be actually doing our best in terms of improving our programmatic redress to the challenges, but also we will be also leveraging our non-programmatic interventions in the forms of technical assistance, advocacy, partnership, and constant engagement with governments and associations, business associations, and other stakeholders, including financial institutions, to improve the trade financing landscape in the region. So we believe that this new evidence generated through this new report will really be very instrumental in terms of improving our evidence base to push for the betterment of the trade financing landscape in the region. I think that's enough from my side. I look forward really to a lively discussion and to learn more about the challenges and also the opportunities that are available, and also learn from other stakeholders that in terms of the issues that we can collectively really do better to improve the situation in the region. And I really welcome everybody to this meeting. I look forward to a lively discussion. And back to you, Shakila.
Thank you, Getachew, and we acknowledge, I think, both Trademark and ourselves, the support that FCPU has given us over the years and continues to give us. And thank you, and Mark and Frank as well, for setting the stage for the report discussions, because you've spoken a lot to a bit of the issues that have been raised in the reports. I hope everyone had a chance to go through it, but Reza from Open Capital will just take us through a very brief summary of the lengthy reports. Reza, over to you.
Thanks so much, Shakila, and good morning to everyone. Just as the slides are coming up, just wanted to, I think, echo those comments from everyone so far. I think, we're really pleased to launch our reports here. It's been excellent working with both Trademark and FSDA on this important topic. I think it aligns very closely with our mission of advancing African economies as at Open Capital. So really looking forward to this event. I think I've seen already full of vibrant panelists and key stakeholders. So we'll keep this fairly brief. What we wanted to do here is share a brief summary of our report. And as Shakila mentioned, hopefully you've also had a chance to look through it as well. And if not, then can do in the coming days. As Shakila mentioned, just a quick introduction. My name is Reza Fazal. I'm a principal at Open Capital. And we are a Pan-African strategy consulting and financial advisory firm. So moving to the next slide. And again, I think touched on this already, Frank did, around what we look to cover here. So as you can see, a fairly broad scope, several countries, a large geographic scope, as well as sector focus, looking at three very distinct spaces in agriculture, construction, and textiles and garments. But really the ultimate goal is to think about how we can come up, and what we want to discuss as well here today, many of those actionable, implementable recommendations to boost the trade finance sector, specifically for that unserved segment of SMEs. So we went out, had several consultations with many of the senior stakeholders in the space, everybody from the public space as well as the development partner space. And then of course on the private side, speaking to the financiers as well as the companies themselves. As you know, there's also a lot of work that has been done in this space. AFDB released several studies on an annual basis, but this in many ways has been the first in-depth report for the East Africa and Horn of Africa region, and also for these specific sectors. So looking to leverage all those databases and those research pieces to get very granular for this part of the world. So moving to the next slide, just a quick intro. I think it's thank you. I think something that we all know, trade is critical, right? Trade is very much the driver of growth in this region. And as this graph shows, it's something that we need a lot more of, not just on the continent, but specifically in East Africa. There's a lot more opportunity here to grow our trade volumes, and trade finance being a critical channel to amplify those numbers. Obviously, as we think about the African Continental Free Trade Area Agreement, this is a hugely exciting and encouraging catalyst for boosting trade. But also what it means is, more increased demand for things like tier 2 financiers to step into that space and fill that gap. And of course, increased call for coordination among actors, among the different geographic actors as well. So just sort of setting the scene there in terms of the need for trade, which I think is something that we're all very familiar with. And moving to the next slide, what we did here was really look at trade finance across the 5 key categories as they're most commonly known for. And we did a deep dive on each of these 5. So everything around documentary trade finance, which is primarily the most common form of trade finance in the region, thinking about letters of credits and those sorts of documents. But we also looked at more sophisticated forms of trade finance that are perhaps more prevalent in other parts of the world, but have opportunities to really grow and expand over here. So things like structured commodity finance, also looking at trade insurance, the different forms of supply chain finance, so everything around factoring, as well as sort of the other side around reverse factoring, distributor finance, as well as export and credit agency finance as well. And what we'll see as we go to the next slide is consistently, and this is something that was in many ways hypotheses that we came in with, having looked at several of the previous reports and from our earlier work in the space. But it was remarkable as well in terms of consistency from all these consultations around what these core barriers are. And I think, one thing that we really want to drill in is this opportunity now to use, in many ways, the external environments around COVID and other things that are, in many ways beyond control, but use that as an opportunity to now look at the trade finance and trade infrastructure as a whole as a much more holistic ecosystem. And I think if we can do that, we can then stand a chance for much more sustainable growth as we also think about some of these individual barriers. So for example, when we looked at agriculture, things around high collateral and high pricing, which in many ways is also common across other sectors. But a lot of things here which COVID amplified. But I think what was clear was this overarching barrier of thinking about what is it actually at the ecosystem level that we also need to solve, so that all the individual interventions that many actors are doing are achieving the impact that they need to achieve. So if you flip to the next slide, what I mean by that is thinking about both the demand and supply side. So for example, when we think about horticulture SMEs, oftentimes they are priced out due to risk perceptions from some of the tier 1 banks. So effectively what it comes down to is thinking about structuring incentives across sectors more appropriately. And that is where I think there's a huge opportunity now, with the African Free Trade Agreement, with all stakeholders coming together in a much more coordinated way, to really look at the ecosystem holistically. How can we continue to now develop interventions which really boost trade finance at that ecosystem level, while then also thinking about some of the individual interventions that can be much more targeted. And so from our findings, from our analysis, discussed obviously very closely with the trade finance and FSD Africa teams and other key stakeholders, we landed here with 5 core opportunity areas, 3 around the ecosystem solutions, and then a couple around very specific trade finance instrument solutions. Because as much as it is critical to look at the barriers holistically, at the end of the day, we also need to think about how can we boost receivables financing, for instance, or reverse factoring in many of these parts where there is huge opportunity to do so. So looking across the board, everything from the regulation side, managing risk, as well as the opportunities that technology offers for this space, and taking in learnings as well from case studies in other parts of the world, especially in Asia, where there's some parallels that we can draw from. So what that led us to, if we go to the next slide, is from these 5 key opportunity areas, and if you have a chance to see the detailed report, what we have under each of these is some very specific intervention opportunities tailored not just to the instruments, but also to the specific geographies and sectors. So for example, details around warehouse financing in Kenya, Uganda, Rwanda, but across the board, going back to that important insight of how we tackle these at an ecosystem level. So here, some no need, don't want to go through these in detail for this discussion, but some very specific opportunities do exist for getting more sophisticated on documentary trade finance, and then trying to really build on some of the initial pilot studies for some of these maybe more, nascent type finance instruments for this region, around structured finance, cross-border finance, indeed trade insurance as well. Lots of opportunities there to think about how we can amplify those. And I think, hopefully this is a good tee up as well for the panel discussion. But I think here is where we can think about how we leverage technology, how we think about the opportunities around cross-border trade, how we think about building sophistication for these instruments, and thinking about how we look at key demand and supply dynamics, so that we're really building trade infrastructure for growth. And I think to conclude on the next slide, I think as Frank mentioned, actually, we've already started work with trying to now actually act out some of these interventions and bring these activities to life. So already working on designs for TA facilities for some of the agriculture SMEs in East Africa, to help them build their competitiveness, almost in a sense to get them to trade finance ready. And that's on the supply side. But then I think very importantly, on the demand side, and then very importantly on the supply side of this, what we've seen is you have many of the tier 1 banks who are doing a great job with regards to thinking about trade finance at sort of the more multinational level. But when we really look at the opportunity for SME level businesses and the opportunities that they can access for trade, there's still a lot more that's required from the supply side, especially from the tier 2 financiers who already understand the segment, but maybe are open to thinking about how their depth of trade finance product offerings can be built. And so some interventions already started there, helping them think about how the balance sheets can be built to allow them to serve these SMEs in this example more critically. So that's just sort of one small example around how to think about it from that integrated demand supply side, very targeted holistic interventions. And there's a link there. I think all the materials are also available on the website with the detailed report, as well as the very specific focus notes that are sector specific, as well as all the intervention opportunities. So, wanted to do a very quick run through of the approach that we took, some of the key findings that we had. Obviously, there's a lot of detail behind this. This is a huge task in itself, and also includes several pieces of technical analysis. All those details can be found in the report, but the objective really was to spend a few minutes to hopefully set the scene for the team and the panel to have a useful and solution-oriented discussion. So with that, I'll pass back to Shakila and the team to take us into the panel. Thank you.
Thank you, Reza, and thank you to the Open Capital Advisors team for conducting this research on behalf of Trademark East Africa and FSD Africa. And as Reza has mentioned, we do have at least an abridged version of this report available for download, but we will share it after this webinar to all the registered participants. And this will include also focus note that will on the specific sectors of focus, which were the textile sector, the agriculture sector, and the construction sector. And thank you, Reza, for setting that wonderful stage for the panel discussions. And as we go into this, I'd like it to be as interactive as possible. So please feel free to include your questions in the Q&A session. We will answer them. We will try our best to answer all questions, so don't be shy. I will now hand over to Jared Osoro, who is the Director for Credit Markets at FSD Africa, who will be moderating the panel discussion. Jared?
Yeah, thank you, Shakila. Thanks, Mark and Getashu, and as well as Reza for your initial comments. Just to say that I'll encourage participants to have a go at the report itself, because it's very rich and it forms a basis for us to have a discussion this morning around this important subject of trade finance. Before I introduce my panelists, I just want to say three quick things. The first one is very obvious from the study that there's an imbalance when it comes to trade finance and trade generally in Africa at two levels. At the global level, our level of participation is not as substantial. And the intra-African trade is also has a long way to go. So I think there's a role in which trade finance will go in terms of addressing those two imbalances. The second one is that trade finance is really is obviously important, but it's not the only underlying challenge. There are quite a number of non-financial challenges that need to be addressed for our trade regime to be competitive. And I think some of the discussion we'll have will be looking at how you consider the whole area of constraints with a view to seeing how they can be addressed and how trade finance can be a catalyst for that. And the third is, and this is something that Reza has highlighted in his overview. The three sectors that the study has explored are really very important. They have uniqueness in their own sense, but I think they have one common thing. All of them are characterized by long value chains, which therefore means that they have an opportunity for having strong multiplier effects in the economy. So if we address the challenges that are characterized by these three sectors that have been highlighted by this report from a trade finance standpoint, I think we have an opportunity to unlock the potential for them to contribute substantially to the development aspirations of the region and the continent as a whole. So to shed more light on the study, I'll be having a conversation with an eminent panel of 5 truly qualified and experienced professionals on the subject. The gentlemen that I'm going to have a conversation with in their own respective capacities are subject matter experts, but collectively they're able to address both demand side and supply side issues insofar as trade finance is concerned, and therefore they'll give us an indication of what will be the practical things that we can take out of this as we seek to enhance the potential for trade finance to support or catalyze development of Africa. Other than the regrettable fact that the panel is only made of gentlemen, and I think next time we'll probably be more deliberate to balance, we couldn't have asked for a better panel. So let me just give a quick introduction without going into details, because it's a high-profile professionals with a public personality. So I'll basically give a very, very short introduction, and then we'll go into the subject. We have Paul Mugai from Equity Bank, one of the tier 1 banks in Kenya. Paul is an accomplished professional who has worked across the banking sector in Kenya. And he comes to this panel from a bank that has a regional presence. So if you want to talk about trade finance in a regional context, I think Equity Bank has that presence, and Paul will be sharing with us some perspective in that regard. We have Jaswinda Bedi. Jaswinda wears many hats and is a man of many accomplishments. But he speaks today both as the chairman of the Kenya Export Promotion and Branding Agency, as well as a business leader and a board member in a number of public and private sector agencies, a true champion of regional integration and international trade. So we're very happy to host Jaswinda in this forum. We also have Anish Jain, who is the Chief Treasury Officer of the ETC Group. ETC Group is a diversified agricultural conglomerate that owns and manages vertical integration supply chains across 5 continents. So it brings that global experience and how it relates to the local scenes of us supporting agriculture is concerned from a trade finance standpoint. And then we have Lamin Drama, who is the head of trade finance at the African Development Bank. The African Development Bank, of course, is the premier DFI in the continent that supports the various dimensions of African development. But today we are going to focus on the trade finance aspects. And then last but not least, we have Ruchin Gupta, who is an investment executive at CDC Group, which is a UK DFI. Ruchin is also very experienced with a focus on trade and supply chain finance in Africa and Asian markets. So he comes into this panel with a flavor of being able to see what we're doing in the continent through the interventions and how that relates to what other countries are doing and what lessons we can learn from that. So I think with that, let's dive into the conversation. And I'll start with Paul from Equity Bank. And my question would be that obviously trade finance is important. And as has been illustrated from the study that has been highlighted, we obviously have constraints insofar as trade finance is concerned, especially to small and medium enterprises who are seeking opportunity across borders. So to what extent do you think banks such as Equity and the banking system is mainstreaming trade finance as opposed to the conventional financial products? And are there creative ways in which it's addressing the risks associated with trade finance so that it's now mainstreamed and therefore a conduit for enhanced trade finance in the region? Paul.
Okay. Yeah, so good afternoon, everyone. It's really a pleasure being in this panel and also in this discussion. So thank you, Jared, for that question. So one of the ways Equity Bank mainstreams trade finance is, trade finance is one of the biggest NFI, non-funded income revenues in this bank. So one of the things Equity Bank did was we were a small player in the trade finance space. So last year, they employed a group of specialists, from the various banks in this market, and put in a team that can boost the trade finance business in this bank. So that was last year. So those are some of the things we've been doing. So one of the ways, and you've rightly said that there's a lot of impediments, and especially for SMEs doing doing business, and most banks have been used to giving them the traditional debt, whether it's getting a loan or getting some working capital, whether it's an OD or something like that. So some of the ways Equity Bank does, some of the creative ways we implement for our SMEs is we try and introduce credit insurance for these SMEs, such that if there's any incidents of default, then we're able then to fall back on the credit provider of the insurance provider. And then another way we also do is we also provide collateral management, of course, through another provider, through an outsourcing provider, who then is able, and especially this is applicable to whether it's the agricultural SMEs, who need to store up some of their commodities, then we will always, try and hook them up with a collateral manager, who then will be able, of course, to store up their goods in a more organized way, and the bank then is able to take that as security. One of the other ways that we also creative ways we also try and assist and support our SMEs is the use of escrow accounts. We will open escrow accounts for these SMEs, and then we will then ring fence the receivables from this customer, and then be able to use that to pay off any liability they have with us. Yeah, so Jared, those are some of the ways that Equity Bank will be able to be able to support our SMEs.
Yeah, thanks, Paul. And I think I just want to make a quick follow-up question on that, because I think the perspective you've given us is around how Equity is managing the risk associated with doing trade finance, in the process introducing other layers of players, including the insurance sector, the collateral managers and all that. I don't know to what extent that has really supported the uptake of trade finance products, because I think when you start again bringing in an alley of other players, there's a cost to it, the final uptake of the financial product, which itself could be a constraint to uptake of trade finance products. Are there any other ways that can be more cost friendly, especially to SMEs, beyond what you just said, as a way of managing the risk from your hand, but at the same time supporting uptake of trade finance products?
I think, Jared, just the quickest thing that's coming from in my mind is what we also do is we also educate our SMEs, and we try and show them the easiest route or the most efficient way of doing business for them. So we will go into their premises. We do training. We capacity build. So that they can actually know what kind of products they can be able to use, and so that then they can then be able to to get the uptick into for using the trade finance products. So Jared, that is one of the ways, the quickest way we can be able to support our SMEs.
Thanks for that. I'll have a follow-up discussion with you on some of those aspects later. But for now, let me move to Jaswinder. And your obvious passion for export promotion is evident. And I know you also have a very strong passion on the cotton and textile industry, which is an area of your specialty. But to get started in terms of our conversation, I want you to give us some broad reflections on why you think trade finance is really a key constraint to tapping opportunities for regional and international trade. Obviously, there are myriad constraints to export generally. Some of them could be internal to the agents that are actually doing exports. From non-competitive production practices, the technology deployed. But I think trade finance may be one of the constraints. In your view, to what level do you think trade finance is a pain to people who are seeking opportunity at the regional and international level, insofar as trade is concerned? Jas?
Thank you, Jared, for your question. And I'm very glad that we're having this webinar today, because in my mind, and I'll talk in a very wide angle context from being the chair of the Kenya Export Promotion and Branding Agency to being one of the pioneers for exports in Kenya, in the textile apparel space, and with investments in the region. I mean, to me, it's very, very simple. And unfortunately, there are only 5 drivers to one word called competitiveness. Because if you're globally competitive, either you're world class or you're no class. You can't be sitting here in Africa and saying, oh, we are in Africa, give us an extra $1 for this product. You're not going to get it. The truth of the matter is that we need to be world class, and we need to look at our drivers of competitiveness. And if I look at all of our drivers of competitiveness, there are only 5 drivers of competitiveness, whether you're in Kenya or in China or in India. And those drivers of competitiveness are the following. One is the BOM, which is the bill of materials, which in Kenya and in the region, we're all buying at world price. So there's no competitive disadvantage from us securing our raw materials for production. Second is, of course, the cost of utilities. In this, and I'm carefully using the word utilities purely because utilities includes water and power. And yes, some of our countries in the region, for example, like Ethiopia, might have the lowest cost of energy, and so that falls under utility. 3 would be logistics, and that's a big driver of costs. As we all know, inland transportation in Africa is a big cost, and logistics with SGR, it's also got to do with speed and this and the other, but that's a cost of doing business. And then the 4th one, I would not call it labor. A lot of people would like to call it labor. I would like to call it productivity, because in China they have higher labor than Kenya, but their unit cost of production is much lower than ours because they're just producing a lot more in that 1 minute, in that standard average minute that they do production. But by and large, the last driver, and to me, which is the most important driver, is finance. The cost of finance and the tenor of finance. And I don't think our banks in this region understand trade finance, because on one hand, we talk about being globally competitive. And on the other hand, the interest that you end up paying in the region is far higher than the global benchmark. I mean, the rest of the world, in India, China, all these guys are borrowing at 2, 3, 4% above LIBOR. Here, there's a floor price. There's a floor price for that 7% is your floor, and we will charge you 1 or 2 or 3% above 7. So already, if your competitors in Asia are borrowing at 3 or 4%, and you're paying 7 or 8 or 9 or 10%, you're already 100% worse off. Your cost of finance is 100% more, double the cost. And when you load it onto your product, you actually realize that it's a big cost of doing business. And now if you look at the textile and apparel space, which is what I think Frank did mention in his opening remarks, that a company in the EPZ found it very difficult to source finance in Africa and in Kenya, which is true. The truth of the matter is that we just don't understand what is trade finance. It's easy to say, we have got trade finance and we do this and we do that. But unfortunately, if you look at one value chain, the textile apparel value chain, which is today in Kenya, the 4th largest export in Kenya, we do $6 billion of export. $471 million was in one value chain, which is the 4th largest, number 1 being tea at $1.4 billion, and horticulture, floriculture is second. Number 3 export is petroleum re-exports. Number 4 is textiles and apparel, which is ahead of coffee. But $471 million business that Kenya is exporting out of from this country, I'm 200% sure that the Kenyan banks don't have more than 10% of the pie. 90% of the pie is with foreign banks in foreign countries, purely because they understand trade finance and we don't. So we have a serious disconnect with what we call trade finance, what is really trade finance. I mean, for example, in Kenya, if I go for trade finance, we'll talk about it. I'll put everything on the table. At the end of the whole discussion, the bank will ask me, but what guarantee are you giving me, or what security are you pledging to this trade finance? But trade finance is not done on securitization or collateralization. It's actually done on an import LC, a back-to-back, and that is a collateral, because you're doing business off the back of your customer's balance sheet. For example, I've just recently started doing business with Walmart, which is one of the biggest companies in the world. And I don't think anybody can rate Walmart as a number 2 customer or a grade, it's a AAA customer, triple plus customer, whatever you want to call it. But that LC in Kenya has very little value. And that LC inverter has a very different value. So we just don't understand that how can we use instruments of funding. Factoring is not known. Again, the recourse is back to the exporter. Yes, we talk about Africa Trade Insurance and we can insure the debt. But why would I increase my cost of insuring an invoice by paying another 1.25% over and above a highly cost of finance? So if I'm at 8% interest per annum and I have to pay every invoice 1.25%, I'm already touching 10%. So we need to understand that we can grow the pie. And if you look at the textile apparel business in the US under AGOA, it's $100 billion. Africa is exporting, all countries, including Ethiopia, 1.1 billion was last year's figure. I mean, it's a shame. We're doing 1% of that US market and we are duty free. to the world's biggest market. I just don't understand that why we can't put all the 5 drivers of competitiveness and all the cogs in that wheel and drive this machine. We can create so many more jobs, but we all need to take onus, increase the size of the business, increase the size of the pie. Even that 0.5% interest will be so much more in a bigger pie as opposed to a smaller pie. So I'm open to questions, and I know there are other panelists, and I don't want to take the show away, but really speaking, I think there's a fundamental disconnect with what is trade finance in this part of the world and the rest of the world, and yet we need to compete with the world. I thank you very much.
Thank you, Chaz. And I think you raised an important point that the study highlights, where collateral is being flagged as a main constraint, whereas perhaps trade finance needs to be structured in a different way. And that's a conversation I'll have with the financials in the room. Now moving to Anish, and I think Anish, you come with a slightly different experience considering your global presence here. You play a very prominent role insofar as supporting the farmers and your partners at the local level. And I think because of your big size of balance sheet, you're able to leverage that to access funding to enable you do business. I see a sense of asymmetry here because whereas you're successful, I'm not sure whether your partners at the local level are successful to the same extent. So to what extent then can you say that you are able to unlock opportunity for the local level farmers who are your partners in terms of accessing finance to be able to have an opportunity of participating in the global arena in a small way as small and medium sized enterprises?
Thank you, Jed, and thanks for the question. And first of all, I'm delighted to be part of the discussion. I think you have touched upon a very important aspect, and this relates to a larger value chain. When any organization of our size, which is operating in multiple countries, in sub-Saharan Africa, we are operating across 30 countries, globally close to 50 countries. The kind of balance sheet size that we have allows us to attract capital from different parts of financial institutions, commercial banks, and DFIs. At the same time, it becomes our responsibility to ensure that value chain partners who are either supplying the products or commodities to us, or they are buying commodities from us, they will get also benefit of this funding access that we have. While in a lot of cases, financial institutions don't see smaller players in the value chain as creditable, where they can write a credit check. But at the same point of time, since we have direct access to these producers or processors, we can become a valued partner with them to meet their short-term requirement for credit facilities. So how we work is, first of all, let's take the procurement side, where we work with millions of smallholder farmers across Africa. First and foremost, we help them to procure their crop at the right time, at the right price, which means that as soon as the farmers have harvested their products, they can bring it to our warehouses and we can pay them on cash. This allows the farmers to unlock the value of their crop without worrying too much about storage facilities and carrying their inventory for a longer period of time. The second place where we help our value chain partners is to extend supply chain facilities where either we are buying from them or we are selling. So they get access to, let's say, a 30-day, 60-day, or a 90-day credit period where they can do different parts of the value chain. And it allows them to work in such a way that they have some kind of linkages in the value chain with us. And at the same time, they are also getting connected to the international destination markets. And third way, which we are also exploring to work with our financial institutions, is how we can make the credit facilities directly available to the small and medium enterprises, and even to the micro enterprises, which are essential part of African economy. So there we have done some pilot trades with a few of our institutions where they allow us to look at these institutional partners or their SMEs, where based on our track record with these institutions over a period of last 3, 4, 5 years, we can provide some kind of a credit history and track record. and help the financial institution understand that what kind of credit worthiness these clients will have. And may not be directly, they may not be very creditable, but through our own means where ETG has a buying or a selling relationship with them, we can extend our supply chain financing to these partners. So these are some of the ways where we have worked to enable our valued partners right from the inception where a farmer produces and harvests its crop all the way towards the end of the value chain where we are processing and selling the products to the end markets. So this way we try to add value, and certainly there's a bigger role that needs to be played by the financial institutions because ultimately they are the capital provider and they can take a credit call in terms of enhancing the availability of liquidity in the markets. Thank you, Jay.
Thanks, Anish, and you raise very important points there in terms of how you're able to support your partners, especially the small agriculture holders. My follow-up question then would be: I think the same farmers are still finding it very difficult to access funding, even with your support, which therefore gives me the impression that there's probably more that needs to be done than the comfort that you give through your value chain support. Is it a view that you share, or there's more that the farmers themselves need to do, or there's more that the funders need to do to make sure that the farmers are actually able to access funding?
Yes, I think it's a fantastic follow-up question, and I would say in this case the devil lies in the detail, because when we look at the access of funding to the last value chain, or when we look at the smallholder farmer, there are multiple challenges which are associated in identifying these partners and what kind of history that they build over a period of time. Because if you will see the financing coming from a financial institution, and I'm sure when Lamin and Ruchin will speak, they will touch upon these aspects, that finding the credit worthiness of a smallholder farmer becomes extremely difficult. Usually in a smallholder farming space, there is a family of anywhere between 4 and 10 people who are jointly working as a family. And given the kind of commodities that they grow, they keep on changing every year, every 2 years, they rotate their crops. It becomes very difficult to write some kind of credit limits on these farmers and give money extended directly to them. So in this case, what we have tried piloting is working with farmers in such a way where we can provide them insurance on their crops so that they, in any form of eventuality, they are covered with an insurance. Second is to work with them to offtake their product, and against that offtake agreement, a small token of money can be extended to them upfront, whether it is in form of fertilizers or agrochemicals or inputs, or in terms of seeds which go for their plantation. And with the help of our fertilizer and agrochemicals division, we work with them to provide extension services to the farmers so that these farmers, when they are organized in a formal program with us, we start developing information about how these farmers are behaving, what kind of crops they are producing, what is the output of these crops that you can expect over a period of time. And keeping this kind of an information in mind, what kind of liquidity or capital can be provided to them during various stages of their farming practice so that they don't need to struggle for financing at each stage. Thank you.
Thank you, Anish, for that response. Now, let me move to colleagues from the DFI space, starting with Lamin. Obviously, African Development Bank is a major player in the development space within Africa and in the financial sector. It's easier to infer that your prominence is indicated in the amount of resources that you deployed in supporting trade finance. And yet, even with that substantial resources that you've deployed, SMEs are still finding it very difficult to meaningfully participate in cross-border trade. So do you consider your intervention by very fact that you have deployed quite a bit of substantial resources as a success if the SMEs are still struggling to find themselves unable to participate meaningfully in cross-border trade? Lamine.
Thank you very much, Jared. Good afternoon to that side of the world. It's still morning in Cote d'Ivoire here. It's a pleasure to be part of this panel discussion. Jared, I think you've raised a very important question. Of course, we cannot beat our chest right now to say we have succeeded in even denting the gap. But we have done quite a lot since we got into this space in 2013, of course, informed by the need of doing more to support local corporates and SMEs in Africa in trade finance. We indeed one of the, if not the latest MDB to enter the trade finance space. And so over time, we've done close to $5 billion of support ourselves, which has, with the leverage, supported at least $10 billion of trade over the last 8 years or so. So that's quite significant. And this includes both funded facilities, soft commodity financing, lines of credit to commercial banks, as well as risk participation, where we underwrite the risk of local banks in Africa that are taken through confirming banks. So it's been quite significant. But we realize, of course, we are not alone in this space. Regional DFIs like Afri-Exim and TDB, which are especially dedicated more to trade finance, have done quite a lot, especially more recently. And we've seen an influx or an increase in the funding from other DFIs and MDBs, including CDC, I know, which is here. We've seen EIB doing more, EBRD in North Africa, as well as OFID, who have all increased their capacity in Africa. But having said that, I think there's still a lot more that can be done. Of course, globally, we know trade finance gaps are rather smaller in places like North Africa, North America, or in Western Europe for very few reasons. One is that there's a preponderance of open account trading, where importers and exporters deal directly with one another with limited bank financing involved. But as well, that the financing opportunities provided by the commercial banks themselves are quite significant, that the gap or the constraints SMEs find in those places are low. So if Africa really has to basically close this gap, then we need to see greater funding or participation by commercial banks and other financial institutions, and not really MDBs, as well as a lot more open account trading, which may be spurred in part by inter-Africa trade. Now, coming to your question itself, 40% of the trade in Africa, international trade, is bank intermediated. So banks support at least 40% of trade in Africa, which is something in the range of $400 billion a year out of almost $1 trillion of trade that Africa does. So that is quite significant. But SMEs, we know, account for at least 80% of enterprises in Africa. Yet they account for only 35% of the trade finance assets of commercial banks. So 80% of the enterprises are SME, but they account for only 35%. So there's a lot more that needs to be done. And we've also realized that 40% of the requests, trade finance requests made by SMEs get rejected. And the number is much smaller for local corporates or multinationals, which tend to be favored. So SMEs really do not get what we would say they deserve from financial institutions. But however, there is a catch. We've also looked at the non-performing loans, generally. I mean, for all trade finance assets, that is for SMEs and local corporates, MNCs, on average, it's about 6% NPL. But for SMEs, it's 10%. And in East Africa, it's even higher at 13%. Of course, when you go to Central Africa region, it's more than 20%. So SMEs indeed do tend to pose a bit more risk to banks than other players. And therefore, perhaps that's one reason why their access to financing is also constrained. So I know, you referred to the study that we did, which was published last year, and that looked at the reasons why banks reject the trade finance request of all their clients, but more particularly of SMEs. And 3 or 4 points stood out. One, it's something that Anish mentioned, is creditworthiness. Weak creditworthiness, 30% of the banks surveyed rank that as one of the most important reasons why they don't give out a lot of facilities, especially to SMEs. The second one is inadequate or lack of collateral. I know that's been mentioned in the study. So it remains a key consideration. Now we need to find ways of seeing how we can do with collaterals, but that has been a key constraint. The other one, which we didn't see way back in 2013, but more prominent now, is compliance, AML KYC constraints. And this affects more the SMEs than bigger corporates who are able to provide adequate information to assuage the concerns of regulators and banks in terms of their compliance. Of course, there was a fourth factor which dealt with a lack of adequate credit lines from international banks. But so these 3 factors that I mentioned, weak creditworthiness, lack of collateral, and compliance are actually hindering SMEs access to financing. So yes, a lot has been done by us and other MDBs and DFIs, but a lot more can be done if you put our heads together. Jared?
Thank you, Lamin, for that. And I think I have a few other follow-up questions to ask around what you just responded. But for now, I'll move to Roshin. Obviously, you share some similarities with African Development Bank insofar as your international model is concerned. As a DFI, you usually intervene through other intermediaries, and therefore the expectation is that those intermediaries will actually channel those resources ultimately to SMEs that, as Lamina said, are a cog really in driving the economies of Africa. Now, the levels of success differ from one region to another. You deploy the same instruments that you do in Africa in other markets. Are there any stark contrasts in terms of the landscape, given that varied levels of success insofar as deployment of trade finance resources is concerned? Because obviously our success story in Africa is not that stellar. But in Asia, for instance, a market that I know you have a bit of experience, you have a different story. So what is really the difference here, and what can be done differently so that we can start seeing your intervention as a DFI making more meaning in the African continent?
Right. No, thanks, Jared. Thanks for that question. And I think just to acknowledge here, I think all the panelists have made all relevant points in terms of the trade and supply chain finance space. And as a DFI, as an active player in the market, I could recognize all these points and all these perspectives, right, coming from a bank and an equity bank. And Paul made a perspective in terms of how banks trade finance in the market. And just when they're in niche, sort of talking about wider challenges with trade and trade finance with SMEs. I think Lamin made a very interesting point, which is very much similar to how we see African market as well. So all these resonate strongly with us. Just from a CDC perspective, I think your question is very, very pertinent because we do work across Africa and South Asia market. And it gives us a unique perspective to draw parallels across these 2 markets in terms of trade and supply chain finance space. Just for benefit of everyone, I would like to contextualize in terms of CDC's trade and supply chain finance book in both these markets, just to sort of share how we work across these 2 markets. So trade and supply chain finance is a relatively new program for CDC. We started somewhere around 2015, not long after AFTV. But we have been actively in this space for the last 3 years. And over this last 5 years, 6 years period, we have supported over 17 billion of trades in Africa and South Asia. And Africa is 60% of our book, while South Asia is 40% of our book. So it is very much, it gives us a very sort of clear perspective in terms of some of the trends that we see across Africa and South Asia. In terms of what we have seen, I think a couple of points around challenges in Africa and South Asia space, and I'm specifically focusing on some of the South Asian markets which would be relevant comparables for African market here. I think some of the challenges remains the same. So when we talk about AML and KYC done by FIs in both these regions tend to be same. Understanding of trade finance products, there is a bit of a difference, but it largely still remains less understood in both these markets as compared to some of the developed markets like Europe and US. And also some regulatory challenges and margins on trade finance transaction are again same. I know just on the made a point in terms of the pricing in Asia versus Africa, and that remains. But if you talk about some of the countries in South Asia, countries like Bangladesh and Pakistan, I think pricing could be very comparable to some of the African markets. So those challenges are continuous between these two regions, these two geographies. But I think some of the key differences that we have seen is that trade finance as a product is more embedded in Asian market, especially when you talk about some of the trade hubs like Singapore and Hong Kong and the banks operating in those environments. I think they have been using trade finance products for the purpose of imports and exports for a longer time period. So those products are not new to the markets per se, and the banks do have a proper offering to go into the market and offer it to either corporates, large corporates or mid-market corporates, even to SMEs. Whereas in Africa, we feel and we've seen that some of the trade finance products is not hugely embedded. We see large banks, South African banks, Nigerian banks, Indian banks playing a significant role. But if you start to talk about some of the regional banks, some of the smaller banks, tier two institutions, they don't have a much wider offering on trade finance as a product. So I think that's one thing to keep in mind, that how banks and FIs sort of use these products as an offering. Another thing what we have seen, and I'll specifically focus on one of the market which might be relevant for this discussion, is that we've seen FIs offer trade finance as a product to SMEs in some of the Asian markets more prolifically than some of the African market. I'm specifically talking about Bangladesh. I think just when they mentioned about the textile industry in Kenya and how pertinent and important it is for the country. I think Bangladesh is probably a very sort of similar comparable, because textile industry is systematically important to the country, and I think Bangladesh has realized that this is an industry to grow. What we have seen in the market is tier one banks or tier two Bangladeshi banks continue to offer these kind of trade finance products to the textile industry. And initially, they might have started with larger names in the textile industry, but when the offering became a standardized product in the market, it also reached down to some of the SMEs in the market, which basically created an equal footing for all the players, either large corporates or SMEs, to be able to take up that product. So I think that's something to understand and reflect, that if Bangladeshi banks could offer it to SMEs as well as large corporates, it's something that sort of Kenyan banks could look at as well. So I think those two comparables are there. I would also like to highlight a few things we have seen in terms of more trends, especially in the COVID environment. We saw African banks suffering from dollar liquidity crunch during the pandemic and post the pandemic. That crunch has been largely taken care of, but it reflects the depth of the capital markets in Africa, where FIs or banks are able to access dollar liquidity or hard currency liquidity for the purpose of trade. We didn't see similar crunch in the South Asian market, at least at that kind of levels, which talks about the the development of capital markets in those regions. So I think that's one thing to keep in mind as well. And one last point for me, draw comparables between South Asia and Africa here. And I think Anish did mention this from a corporate perspective. I think what we have seen is that SMEs in some parts of Asia are more embedded with large corporates and the large corporates value chain and supply chain. And what we have seen is that FIs are more open to lending to these SMEs, which are embedded in large corporate supply chain, which means they are able to access a bit more higher level of trade and supply chain finance from FIs in South Asia. There are pockets in Africa, I mean, especially ETG Group would be a reflection of that, where the SMEs are embedded in supply chain and value chains and are able to access network of FIs either through ETG Group or on the basis of their individual standing. But largely what we have seen in African market is that SMEs are not that embedded, which makes them removed from the formal banking channels a little bit, and which acts as a hindrance in terms of accessing trade and supply chain finance in African market. So those are few trends we have seen, and I mean, this is a moving market, right? Because things evolve, the markets keep on evolving, regulatory requirements keep on changing. But I think these are few learnings that can be taken from South Asian market and putting that in context of African market. Thank you, Jared.
Yeah. Thanks, Rajan, for those, and I think you drew a very good parallel, highlighting the unique circumstances that exist within various markets and how the responses, I think, need to be tailor-made to address some of the unique circumstances in each market. In view of time, and just to acknowledge that, we need to have a follow-up conversation, I'll want to go around one more time to just drill down on some aspects, starting again with Paul. From the initial discussions that we've had across the panel, obviously there are a number of things that are coming out, most notably issues around the regulatory environment and also the risk attitude by the market players themselves. If you recall, I mean, during the global financial crisis, one of the biggest dilemma that many financial market players in Africa had to contend with was the aspect of the risking, where there's a challenge in terms of establishing correspondent banking relationships that can be meaningfully used for enhancing trade finance. Do you see any regulatory barriers, and do you see the risking, especially from a correspondent banking relationship development being an issue here now? And I'm not talking about equity, but I'm talking about broadly in the market, and that will basically be a constraint to trade finance.
Yeah, thank you, Jared, for that question. Definitely, that has been a big risk and a big challenge, for banks in Africa to participate in trade finance, because you'll find the international correspondent banks usually are the ones that confirm the trading instruments. So you'll find, even if say, for example, traditionally the clients for the financial institutions have been importing, and sometimes the suppliers in some of those regions requires the trade instrument to be confirmed or discounted. And then this phenomena of de-risking then comes. You'll find then, of course, there's an impediment. The trade finance will not be able. I mean, the activity then will not be able to take place because you don't have a correspondent bank then to confirm your instrument. So definitely, de-risking has been a big challenge, for the development of trade finance. But I know, I just to maybe, just to sort of like provide sort of like a solution for what has been happening is, I know some of our DFIs and some of our multilateral development banks have been coming up and saying, they can come in and support some of the banks to continue with the activity of trade finance by confirming or discounting the risk on some of those trade instruments. Yeah, so like you said, yes, de-risking has been a big challenge for banks in this market.
Yeah, thanks, Paul. I mean, obviously, I mean, and Lamine can speak to this more because there's a report that they have just published around the response or the market reaction to COVID and any shock revealing itself in risking. So that's really a real issue. And I think unless we start looking at it from that broader policy standpoint, it will continue being an issue. Now, a follow-up question to Jess. I know you highlighted some of the limitations that the market players from the demand side have insofar as accessing trade finance. But beyond the limitations of maybe the financial sector not understanding fully the trade finance product, I want you to offer some brief reflection around what is being done from the context of export promotion. What kind of initiatives and investments has government done to address some of the limitations with a view to seeing that the initiatives they put in place actually propel enhanced regional and international trade?
Thank you, Jared. Thank you, Jared. Basically, as you know, for Kenya, and I speak for Kenya because I chair the Kenya Export Promotion Branding Agency, our exports are about largely $6 billion and imports are about $16 billion. What we saw last year with the pandemic is that imports went down to about $14 billion. So we had a shrunk book of imports. And to my total surprise, our exports actually grew by 7.8%. We were anticipating with the lockdown last year in March and April and May, because our big export driver is fresh vegetables and flowers, horticulture, floriculture. We thought that would be a big damage to or big dent to our export revenue. But unfortunately, or fortunately for Kenya, we were resilient and we were pulled through that lockdown phase until our exports recommenced in October last year to grow. To show actually a growth. I don't think many countries in the world last year saw an export growth. In Kenya, we saw 7.8% export growth. So when we did the YY analysis to see why did we grow and which sector did we grow into, we realized that our exports of tea moved from $1.2 billion to $1.4 billion, $200 million growth. And you do another YY on that, you realize, yeah, a lot of people are staying at home, working from home, and they were drinking a lot more tea. So to answer your question, we are looking at diversifying our export product basket. We're looking at diversifying our markets because right now, 60% of our exports end up going into 5 or 6 countries. And that has been going on for many, many years. So we are looking at diversifying our product offering or a basket, at the same time diversifying our traditional markets. We're looking at a lot of value addition. And by value addition, I'll give you a very simple example in one value chain, the tea value chain, and that's why you must have seen that the Ministry of Agriculture has just published a new tea bill, which is being debated right now. But the whole thinking behind this is that how can we maximize value out of our exports? Traditionally, Africa by itself has been exporting a lot of raw materials as opposed to exporting finished product, and it doesn't really give them any value. And to the tea value chain, especially if you look at our export revenue, we grow about 450 million kilos of tea, and Sri Lanka exports about 300 million kilos of tea. Our export revenue remains at $1.4 billion. Sri Lanka's export revenue remains at $3.5 billion. So they grow 30% less tea than us, and yet their revenue base is more than double. And you ask yourself again, why? And you realize that, you know what, we are just selling green tea, no value addition, and that's the problem. And we need to move away from our traditional basket of raw material sales and sell finished product. I'll give you another example in a value chain in Uganda, where we're actively involved in the cotton value chain. Uganda exports about $50 million of raw cotton every year. And if that is turned into a simple t-shirt, that revenue base can move from 50 million to 750 million. It's 15 times value addition. And it's not so difficult to do. And it becomes their number one export. It actually overtakes coffee, which is at $400 million. So we need to really change our mindset on our product offering. And I believe the same is the case if you go into Ghana and the cocoa sales, and what do they get out of their cocoa or coffee for that matter? what does the farmer get out of that one cup of coffee sold in Starbucks? He gets 2 US cents, but that cup is sold for $3. So I think there's a whole metamorphosis change. And definitely in Kenya, we're thinking of adding value. We're thinking of diversifying our product offering, and we're thinking of diversifying our additional markets with an expanded market. You've seen what we've done in less than 18 months from the time we got green light to export to China, where we were focusing on aggressively. You've seen the amount of avocados we're doing. We're now almost the second or third largest producer in the world of avocados. So we are looking at that type of catapult in our export revenue. Of course, I have a tall order. When I was appointed in this position, I was told that the trade imbalance between imports and export is $10 billion. And your only KPI, one KPI, is that I want imports and exports to equal out, or rather exports to equal imports. And that's a tall order. And that was my only KPI as being appointed the chairman of this organization. And we are aggressively addressing that. I thank you, Jared.
Good luck with that. Good luck with that. Let's see how it goes. Anish, a quick follow-up question. I mean, obviously, given the stature of your institution, it's easier for you to mobilize a syndicate of international banks to support your businesses. Are you seeing opportunity for local banks that are actually more in touch with the SMEs that they serve to also play a role from where you sit in terms of supporting the partners that you have, so that we have an ecosystem as opposed to the big players who have understanding of the global market being the main ones, whereas we have the local players who can actually potentially play that role.
Yeah, thank you, Jed. I think this is a good question, and what we have seen, especially in last 12 to 18 months, a lot of international financial players, especially the commercial banks, they have not been very active in lending space, especially for the commodity business where we operate. And coincidentally, we have seen the credit appetite of some of the large local and regional banks in Africa, whether it is on West Africa side or East Africa side, they have come forward to start filling this gap. And this has really helped the industry in some bit, where these banks have started taking credit calls on large enterprises, as well as some of the enterprises which are not very large, but they are not SME either. And this will certainly help the industry to get access to the liquidity that they need. And at the same point of time, start creating an ecosystem where these local and regional banks will start adding to the value addition that these companies are doing in the agricultural commodity sector. And what I feel that local banks can also play a role is to see that what kind of risk mitigants that they can deploy by taking support from large institutions such as AFDB, and support the local organizations, local SMEs in enhancing the credit limits. Because in many cases, we have seen that local banks, regional banks, they have very good insight about how these SMEs are working and how they are adding value to the economy. And they are sometimes in a far better position to provide that kind of liquidity as compared to an international bank coming and providing liquidity in the local market.
Thank you for that. And I think it's shed more light on terms of the opportunity that is there for local banks sometimes to respond to occasion where the international banks tend to be a bit shy because of either their risk attitude or because of the fact that sometimes they want to play at a different league than what the local market requires. The final one to the DFIs, just before we go into the Q&A and we wrap this conversation, is around the potential market failures and potential policy failures. So beyond financing, Lamin, are there any conversations that you're having in terms of addressing some of the market failures that needs to be addressed for financing to actually meaningfully work? And I know a number of studies that you've done point to some of these market failures, which need to be addressed before you even start seeing how the trade finance itself will work. Maybe you can just take a minute and speak to that.
Yes. No, thank you very much, Jared. Indeed, we've done many studies in this area, but even on the financing itself, there are a few things that we're doing to support that. Risk mitigation, facilities have been created to enable local banks do more with SMEs. So we have to boost Africa, which is SME targeted. And then one of the participants asked a question about women. We also have the Africa Financing Action for Women in Africa, the AFAWA. We are working with Africa Guarantee Fund, for example, to support local banks, mitigate the risk on their SME portfolios. But beyond just the financing bit, there are some other considerations that we need to really look at. We've talked about correspondent banking and the primary reason for that is compliance, AML and KYC. So for us, it's important that we address that for the SMEs, local corporates, as well as for the local banks themselves by doing more training for them, as well as discussing with regulators as to how they themselves need to be up to the mark on AML and KYC compliance so that they could comply to international standards. I think that's a critical factor. The other one is, of course, addressing the weak credit quality generally, and that would be true, like I said, risk mitigation facilities. That those have been very helpful. But we have, a lot of other hard and soft infrastructure issues in trade. Of course, we know how important physical infrastructure itself is in doing trade. Most of them really happen because of trade, but also trade supports development of infrastructure. And quickly, just to give an example of what we had, our headquarters used to be in Tunisia. When you go to Tunisia, in the market, you find bananas from Chile and Ecuador in Latin America. And when we travel to France, we see bananas from Cote d'Ivoire and Ghana or even Cameroon in France. But in Africa, we don't. And we ask, why is Tunisia, for example, not importing bananas from Africa rather than from all the way from Latin America? And you realize it has to do with the shipping lines and the lack of adequate infrastructure support, that will even facilitate that trade between Africa itself. So infrastructure has become a key consideration if we really want to address some of these things. We also realize the importance of the African trade area, especially into Africa trade, which, as you know, is about 17–18% right now, compared to 60% in Europe and so on. And we have been supporting the African Free Trade Area, even the Secretariat. We supported with a $5 million grant so that they can be properly set up and to facilitate more trade on the continent. So there is a lot that we need to do even before we reach the level of financing. Capacity building of the SMEs themselves is quite key. The report, your report indicated that there is even lack of awareness of the trade finance solutions that are out there. So it means financial literacy is a challenge. But beyond that is also their own bookkeeping and the processes and procedures and systems that they have. As many SMEs who sometimes would have two sets of balance sheets, one for the taxman, the other for the banker. So a lot has to be done. And for the financial institutions themselves, it's also to with their capacity to be able to better conduct due diligence and assessment of SMEs. So helping them with scorecards and building the capacity of their staff will all become key if we want to unlock the huge potential in trade and then bring on board trade financing to support that.
Okay, thanks, Lamin, for that. And I think the same question posed to Russian in terms of, in a minute, can you quickly highlight whether you see there any regulatory failures or market failures or constraints that actually will be able to unlock opportunity for trade finance?
Right, Jared. I'll summarize a few things. I think we've seen there are a lot of market failures happening, right? That's why we talk about this large gap. I think from a CDC perspective, what we are looking to do is to market shape this a little bit differently. So I think what we have realized is there's a large information gap in terms of SMEs knowledge to access trade finance. We're talking about the understanding of the trade finance product and also offering of banks on of these products to the SMEs. So I think we acknowledge there's an information asymmetry or information gap in this space. We also acknowledge that there's a perceived risk and an actual risk in terms of trade finance transaction. We can continually talk about trade finance as a low risk transaction. It continues to be a low risk transaction, but sometimes the market participants, and more importantly from an FI perspective or an investor perspective, the perceived risk is much higher than the actual risk. So I think these are the two market failures we have sort of seen in the market. How we're looking to address this is we continue to work with our FI partners in terms of risk guarantees. I think what we want to do is work with more banks and FIs in the space that are in the SME space, who understand the risk, who already have a track record of it, and look to build and enhance capacities of these FIs to do more. So I think that's one solution that we are continue to look at. Another solution that we are looking at is to leverage technology in terms of bridging the information gap, right? So we do see a large role for fintechs, trade techs in the space to provide the financing to SMEs. And what we are trying to do, we're trying to sort of figure out the best way to do this in terms of a scalable manner, is to work across with these trade techs, fintechs, and provide funding to these through these channels to SMEs, and in return build a database, build an information systems with us, which we can then go out in the market and start to promote trade finance as an asset class. So it's going to be a longish journey, but I think if we do this well in terms of going step by step and really building our understanding around the trade and supply chain finance space, understanding about the SMEs, we can start promoting trade finance as an asset class in a near-term horizon. Thanks, Jared.
Okay, thanks, Roshan. I think we've had a very comprehensive and exciting conversation. I know there's quite a bit of comments that have come through the chat. Many of them are comments, and there could be a few questions, but in view of time, we'll be getting back to the participants directly on the comments that they've raised. So we'd like to bring this to a close. But before I do, I'd like to invite the CEO of FSD Kenya, Tamara Cook, to just share some perspectives as a way of wrapping up the conversation around the panel and the report itself. So Tamara, it's your time to just offer some perspectives, some thoughts around the conversation that we've had.
Thank you, Jared. It's been a fascinating conversation, and I think it's been really important to start looking at both the barriers and the opportunities to trade finance in East Africa. In the interest of time, maybe I'll just highlight a couple of questions that I think would be good for us to consider as we move forward. We've recognized there's barriers and opportunities. We all want to see this space grow because we see the potential impact that it can have in this region. In this conversation of these amazing gentlemen, one area that was not spoken about as much was the barriers that women have. And I know that was highlighted in the report. And I'd just like to say that in our own research, we are the facilitator of a Sweden-funded public-private development partnership. And we've done some recent research looking at the specific barriers that women face in trade finance. And we see many things, but it includes 10% less likely to have access to formal finance. So something we can keep in mind. Staying with the demand side of trade finance, we've talked about both this demand and supply side dynamics today. But I think as we go forward, it's important to make sure that we're very grounded in what the demand side needs and the barriers that they face, and not just offering them the solutions that may work in another region or another country, but really understand what the East African demand side needs, especially for smaller enterprises. And I think if we can do that, then we can also manage some of those risks that have been talked about earlier. It was mentioned earlier that there's a higher non-performing loans for SMEs in trade finance, but maybe that's because we haven't helped them mitigate those risks and structured products in ways that deal with those risks, so that there can be better financial solutions, trade financial solutions for these enterprises. So I think, Jared, thanks for asking me to give just some final reflections. I think we're all in this together, and we want to see these particular sectors and trade finance grow in this region. Thank you.
Thank you so much, Tamara. I think you touched very critical things. The gender dimension in particular is very, very critical. if gender disparities manifest themselves in the overall consumption of financial services, they're even more pronounced when it comes to trade finance, with all the myriad of challenges that have been highlighted. And I think you also touched on a very critical point around mitigating the risks that portend themselves to trade finance, because it's easier to run away from a certain category of customers because you perceive them to be higher risk. It's quite another for you to see how you can risk them and actually meaningfully support them. So those are very, very thoughtful. But those are very, very thoughtful comments. And I think we are looking forward to having a much more closer conversation so that we can see how we can start now zooming in on some of these issues. So thank you so much for sparing time and giving those reflections. So without further ado, I think we'll bring this to a close. We've had an opportunity to consider the findings of the study. We've had a very robust conversation, in my view, and I think this joins the body of many studies that have been around this subject. I think now what we need is really to have a sense of follow-up or follow-through beyond studies and ask ourselves the question of what next, because that's really important. And I think there's a recognition that trade finance and therefore trade will play a very great role insofar as even the post-COVID recovery is concerned, if we put our houses in order. So as FSD Africa, we acknowledge there's an opportunity to do things differently. Obviously, there's a chance to embed solutions to trade finance that are technologically endearing in terms of fintech to address information and stuff like that, which just come out in the study. So I think we'll be reflecting deeply on how we can embed fintech and information sharing and all that into addressing matters trade finance. It's obviously clear that the ecosystem for trade finance stretches beyond the funders and the consumers of funding. We need to start looking at how we can bring to the conversation the enablers, both from a market infrastructure standpoint and also from a policy standpoint, so that we have a more comprehensive conversation around trade finance. With that in mind, then, what I'll propose that we seek to have a further conversation between FSD Africa and Trademark East Africa. And this is something that the CEO of Trademark East Africa alluded to. And we can actually have that conversation within the month of May and June, so that we can now have studying to have a much more strategic focus insofar as addressing some of these challenges are concerned. And once we have that conversation, then most likely we'll come up with a sort of working group that takes into consideration the broader ecosystem around trade finance, which will then map out the details on how some of the challenges that have been highlighted in the report can actually be addressed, and whichever opportunity that we see, how we can optimize on those opportunities. So I think as a way forward, it's really to have a follow-up conversation with colleagues in FSD Africa and Trademark East Africa and FSD Kenya, because I think we have a common view so far some of these things are concerned, so that we start now zooming in on some of these pain points, and therefore take this beyond the study. So that's really how I see this evolving going forward. And so for now, I really want to thank the CEO for Trademark East Africa, FCDO advisor, the distinguished panels, Tamara, and all the participants for a very interesting conversation we've had this week. And I wish you a good day ahead. Thank you.
Thank you. Thank you very much. Bye.
Yeah, thanks.